Welcome to America's Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. Learn market knowledge and best practices to lead your company's success. And that's whatever type of company you work with. And laugh, we have to have some fun along the way, don't we? Well, hello, I'm Michael Bull, your host to the world of commercial real estate. I'm sure glad you could be with us today. Remember, if you have any commercial real estate questions, give us a call or send us an email. Our phone number is 800-408-2855. Our email is radioshow@bullrealty.com. Or it reaches through your favorite social media at the show website, commercialrealestateshow.com. Well, we have a great show for you today. First, we'll get an update on the banking industry. You know, as the banks recover from the worst recession since my grandmother was a hottie, sorry, Grandma, the health of banks is an important part of the economic picture, especially for commercial real estate. We'll get an update on the health of banks, including the amount of non-performing debt and the increasing amount of OREO, or is that Oreo? Guys, why do banks have Oreos? Aren't those cookies? Other real estate-owned foreclosed properties, so we'll get a look at that. Then we'll take an inside look into the world of auctions. You know, auctions are an intriguing process, and the more you know, well, the more you benefit. My first guest is Christopher Marinac, Managing Principal and Director of Research with FIG Partners. FIG Partners is an employee-owned broker-dealer specializing in financial institutions. Their expertise includes independent research on public bank stocks and the industry at large, raising new capital, and providing strategic advice for banks nationwide. Chris Marinac, thanks for being with us today.
Thanks, Michael. Pleasure to be here.
Well, Chris, let's get right to the what's going on with the banks. You know, they're obviously an important part of the economic and real estate recovery. How are banks doing these days around the U.S.?
Well, we look at the banking sector, Michael, divided into banks that are above $100 million in assets, and then there's the rest of the industry. The rest of the industry is about 4,000 banks that have more than $100 million of assets. There's another 2,000 plus banks that are less than $100 million, which are what I would call the tiny banks, and then you've got credit unions and savings and loans thrown into that. It probably creates about 9,000 institutions. But the 4,000 that are above $100 million in assets represents about $12 trillion of assets in the country. That really is the industry. The rest of the data, I think, is noise. So when we focus on the 4,000 banks that really matter, that's kind of our perspective. So we saw about 60% of those larger banks actually make money in the second quarter of 2011. Now, that's a big step up from where we were a year ago, or certainly 3 years ago in the fall of 2008 when the economy and the markets were very ugly. In our perspective, this profitability is going to stay the same or get slightly larger. Perhaps 60 goes to 65%. We still have a portion of the industry that's struggling, whether it's related to bad debt or related to poor capital. There are companies that still will fail. We think the failure list is coming down. It's now less than 100. We think the problem loan list, which the FDIC now says has actually crested and is beginning to decline, really forecasts that the failures begin to slow, but the amount of pain in the industry is not going away. And as I think we'll talk about with me and also our panelists today, there's still a fair amount of work to be done in the industry. Credit quality has not been solved and has not been fixed. The economy is still, moving very slowly, although we think the risk of a big recession is small, if not zero. I think that it's more of a grinding, slow recovery that will take quite a while to get back to where we were of the golden age of 2005, 2006.
Well, that's great. It's good to hear. We don't expect another recession. Well, how are the different size banks faring around the country? Are the national, regional, or community banks faring differently?
When you look at profitability, I think that you have roughly that same 60% number, whether you are a small bank between 100 and 250 million, or whether you're in the 10, 20, or even north of 100 billion in assets. The profitability numbers are just modestly different. You get the sizes. You have a little bit less profitability when you're at the smaller banks, but it's really, a few percentage points different. I think it's more different on credit quality. We have more of the smaller banks that are struggling on problem asset ratios being high, whether you look at the amount of problem loans to total loans, or whether you look at the Texas ratio that's often cited in the media. The Texas ratio is simply the amount of problem assets, including Oreo, divided by your capital plus reserves.
Right.
So you have a good, 200 banks that are north of 50% Texas ratio, which is one line of demarcation. If you looked at the numbers above 100% Texas ratio, it's a smaller figure, somewhere in the neighborhood of a couple hundred. So
Okay. And what is your outlook, Chris, for banks for the rest of the year next year?
Just like Punxsutawney Phil, where I grew up in Pennsylvania, I think you're going to unfortunately see 6 more weeks of winter. And that's only from the standpoint of seeing banks come back to real returns. The banks making money, as I mentioned, is a good thing, but the amount of profitability and return on equity and assets are very, very small. And I think it's going to be some time before we get back to the normalized, if you call it anything normal in today's world, a level of profitability. My view is that we have a lot of work to be done to get through of problem assets, get rid of OREO, to sort of cycle through these issues to clean up bank balance sheets. Many banks are well capitalized. Many banks have earnings they can use to throw at the problem assets. It simply will take time. Most credit cycles take 5, 6, even 7 years. This is a credit cycle unlike any other. This may be a 7 or 8 year cycle in which we're only 4 years through.
I see. And Chris, the banks have been working through foreclosed properties. How much foreclosed properties do the banks have right now, and how does that compare to prior economic and real estate downturns?
Sure. If you look at the median numbers, which statistics can always be misleading, the median level of OREO as a percentage of assets, and this is other real estate owned on the balance sheet, and this excludes anything that's related to FDIC loss share assets, in case those in the audience are interested in that. It's about 0.6%, so 60 basis points. But, however, that median is misleading because I would find about a third of the industry, a third of those 4,000 banks that we're tracking that are above $100 million in asset size, a third of those folks have over 1% of their assets in OREO, and you have at least 15% that are north of 2%. So OREO is a rising level. If we went back to historic times in the past, in the early 90s is probably the best frame of reference for myself and for many others in the audience. OREO was about 2.5 to as much as 4 to 5% of assets at its peak. I don't think we've peaked. I think if you think of the sort of proverbial rat going through the snake and through the python, we still have a lot of digestion to go, and so therefore the level of OREO has by no means peaked. And I think that that's going to be where banks continue to sort of cycle through these issues, and they probably take one balance sheet the next at least 4 and 6 quarters, but probably 2 years. We still have a high level of OREO, which is going to keep our friends on the auction side and other disposition consultants very busy.
And that analogy doesn't mean we don't like commercial real estate or banks. We love them, right?
Exactly.
And what types of loans and foreclosed properties are causing the most issues for banks at this time?
I think the biggest issue continues to be raw land. So if you think of commercial real estate as a broad class, you have construction properties, which would be what we call the PVC farms, where you have the sewage put in, but there's nothing else built on top of it. You have the raw land itself. You have some finished properties, whether it be houses or strip centers or office buildings. You also have residential houses that were vertical. I think the biggest issue is more on the commercial and the raw land side, because that's where you have your biggest diminution of value. In my sense, a lot of the vertical houses can be sold. They're easily movable. Sure, they may have 30 or 40% loss factor, but they tend to be easily moved, and I think easier for the banks to digest. It's the 80 and 90, in some cases 98% losses that banks have on raw land that are very difficult to stomach and unfortunately are still housed in certain financial institutions.
Right. And Chris, what are your predictions on the amount of OREO coming up in the next year or two?
If we look at the industry and look at what we think still has to be recognized in terms of problem assets, I would say that in an aggregate sense, we probably have at least $1 billion of work to be done to cycle through problem assets. Now, that does not mean that this is all coming at once in the third or fourth quarter of 2011. Some of this is going to come over time. There are problem assets that are going to be resolved in courts all around the country that simply can't be dealt with today, whether it be because of foreclosure procedures in each state or the fact that someone has not gone bad yet. There are still folks out there paying or had reduced terms that have not officially become a non-performing asset. One of the challenges is, as you've all heard the expression, kick the can down the road or extend and pretend, that has been done, and eventually that comes home to roost. And even if that doesn't happen until late 2012 or 2013, we are going to see those problems come out. I think that that's part of the reason why this cycle is going to be a 7 or 8 year cycle. Doesn't mean banks won't make money and that there won't be plenty of bank survivors. I think there will, but I think it's going to take some time to fully digest and fully get through all of these issues that are still in the pipeline.
So you think it's possible their amount of foreclosed property will increase through the year and the next year?
Yes, and I think most analysts and investors in my side of the world, in the equity community, believe that OREO will continue to rise as a percentage of assets, and therefore banks have to be prepared to not only write those assets down every quarter, but also just to have the capital to sort of warehouse those properties as we go through.
Right. Okay, we're going to take a short break, and when we get back, we'll hear some more from Chris Marinac with FIG Partners about the banking industry, and then we'll get into some auction issues. I'm Michael Bull, and this is the Commercial Real Estate Show. We'll be right back. Commercial Real Estate Show podcasts are brought to you commercial free by accounting firm Babish, Neiman, Kornman & Johnson. Quality, responsiveness, and integrity best describe their accounting and advisory services. Visit bnkj.com. And by commercial brokerage firm Bull Realty. When your business requires proven performance, visit bullrealty.com.